If that hourly or 15-minute time frame draw on liquidity amounts, you think that the market's going to go higher or lower to that specific liquidity. The only thing you're waiting for if you're bearish, and I'll give you the example for being bearish, on the 5-minute or 1 minute, there has to be some short-term high traded above. Even in a run while the market's been going down, don't think model 2022. That's not what this is, okay? It's not that. He can take a trade with that model within that context of the market reversing. We don't need that. The market can be going down for the entirety of the day. If it hasn't traded to that 15-minute or hourly sell-side liquidity pool, it's not done. His model says aim in that direction. If it's 50 handles to get to that low, doesn't matter. He's not holding for them 50 handles. He's trying to get 10. He's not always operating in 10 o'clock till 11 o'clock. He'll trade when he sees that liquidity is presently a draw. And if he wants to be in front of the charts, 30 seconds allows him to take that 10 handle run. 30-second chart is doing 10 handles all over the place inside of 1 hour. But you don't need to have your take profit or your draw on liquidity reach to for the model to work. You need to have an understanding of where the market is likely to reach to. You have to frame a 15-minute or a 60-minute draw on liquidity, where the market's likely to go. And then on a 1 minute or 5-minute chart, if you're bearish, there has to be some run above a 5-minute swing high, even while it's been going down. It has to go up above it and start trading lower again. And then once it does that, you can drop down into a 30-second chart, take a 30-second fair value gap. Because the damage has been done on the 5-minute chart. It could have been a stop run on a swing high in a 1-minute chart. See, that's what a high frequency trading algorithm is doing. Every single one of them has to have a disruption in order flow before they will institute a new order. That means they cannot go short until it goes up. It has to go up. Why do you think I taught you discount premium? Enigma is fucking talking to you. The market has to go up, purge some measure of liquidity. If the market does, I don't give a what market it is, but if you're bearish on a 5-minute or 1-minute chart, if a swing high, a short-term swing high on that 5 or 1-minute chart is taken out by 1 tick and it trades lower. As soon as it trades lower, on what time frame are you talking about? Whatever time frame that liquidity was taken on. If you see the swing high on the 5-minute chart has been pierced by 1 tick is all it takes. It doesn't need to close above it. It doesn't need to have a certain measure of handles above it. 1 tick. Once it does that, that's a disruption. That's a disruption in order flow. That's it. That starts the sell program. Then on a lower time frame, it can be a 5-second chart. It could be a 1-second chart. It doesn't matter. But I gave him a 30-second chart because it's easy to get in there and take a fair value gap after that disruption in order flow, knowing that the market will gravitate towards that liquidity. We need not see it trade to it. It's there every day, every hour, every 15 minutes. It's there. So forget the 90-second or 90-minute. It's every 15 minutes. It's there. I literally could sit there all day long, trade just intraday volatility, just doing what I just told you. Now, intraday volatility, that means you're going to be looking for an hourly or basically 60-minute swing high or a swing low that is likely to move to. It's in close proximity to it. It's been going up for the last couple hours or so, and it's just getting real close to an obvious 60-minute high. If it's not doing that, go down to a 15-minute time frame. Look for a swing high that it might be gravitating to. If it's gravitating towards that 15-minute high, and real important, here's the filter, folks. On a 1 or 5-minute chart, if you're bullish, it must show a swing low taken and then reject and go higher. Whatever time frame, whether it be the 1 minute or 5-minute, whatever time frame that swing low is breached, it goes below it. It only needs to go by 1 tick. Doesn't need to close below it either. It just needs to go below it. That time frame that has the swing low, it must have a candle close up after it takes that low. Once it does that, you immediately drop down to a 30-second chart. Instead of a 30-second, use the 1 minute and use the 15-minute and 1 hour chart. Everything's scalable, but you have to have whatever that time frame is, the 1 minute or the 5-minute, there has to be a stop run. One of the first primary principles I taught when I stepped out on baby pips is the real move will not happen. The dynamic price runs where there's magnitude and delivery and speed, that will happen after a pool of liquidity is engaged. That means if the market's bullish, if you think it's going to go higher, think it's going to draw up to some level, whether it be a high, a relative equal high, inefficiency above market price, whatever that is up there that you're framing as a reason for it to want to go up, it's far more likely to get up there with conviction and speed if there has been a short-term run on liquidity that's below the marketplace in the form of stops or sell-side liquidity, because the market's going to go down to allow traders to buy those stops. What traders? Smart